What if I told you that the cracks in the Canadian mortgage market might already be forming, just under the surface, and that we could only be months away from it reckoning? This isn't just fear mongering. Right now, there's a powerful signal flashing in the credit data. An article in Mortgage Professionals Canada warns that auto loan delinquencies, a classic early warning light, are already rising beyond subprime borrowers. So the question is, could the next mortgage crisis already be brewing? Today, we're going to trace the clues, test the parallels between now and 2008, and ask the question that's on a lot of people's minds. Is the next crash coming? And if so, when? To understand how this matters, we have to start with how mortgage crises tend to unfold. In past cycles, defaults don't begin with mortgages. They start with stress in smaller debts, cars, credit cards, personal loans, and then they spread outwards. That's because auto loans are often the first point of financial strain for middle-class households. They're shorter terms, easy to get, and usually tied to borrowers with tighter budgets. When a family starts missing car payments, it's often because they've already cut everything else. The car payment is the one last line of defense before the home. So when that goes, it usually is a preview of what's to come. The MPC article describes auto loans as a bellwether, a leading indicator of what could happen to mortgages 6 to 12 months down the road. And here's why this matters right now. Households are stretched thin. Inflation has eaten into their savings, interest rates remain elevated, and wage growth just isn't keeping up with the cost of living. When all those pressures collide, something eventually gives. The article's main point is that we could see mortgage delinquencies rise by mid-2026 if this pattern holds. Before the 2008 crash, auto delinquencies began climbing about 9 months before mortgage defaults followed. But here's the important part that's not guaranteed. In the years before the pandemic, auto delinquencies also rose sharply, yet mortgage defaults barely moved. And why? Because homeowners had record equity, stable jobs, and tighter underwriting rules. The article points out that today's market does have stronger foundations. Things like bigger equity cushions, stricter lending, and major differences across regions. It also identifies 3 accelerants that could make this worse: the stock market correction, rising unemployment, and migration back to expensive urban cores. On the other hand, there's a dry powder on Wall Street. Institutional investors ready to swoop in and buy distressed homes, which could soften the major crash. So are we really months away from a mortgage crisis, or is this just noise? Let's dig deeper. To find out, we have to answer 3 key questions. 1, do rising auto loan defaults actually lead to mortgage defaults? Number 2, how different is today's market compared to 2008? And 3, if stress spreads, what could the chain reaction look like? Let's take them one at a time. First, the leading indicator theory. Historically, auto loan delinquencies rise 6 to 12 months before mortgage defaults. That's because cars represents the first crack in the dam. Families can skip restaurants, vacations, streaming subscriptions, but when they start skipping their car payment, it's because every other corner has already been cut. The MPC article highlights that delinquencies are now showing up not only in subprime borrowers, but also in prime borrowers. That is a major red flag. When it spreads to the middle class, the problem isn't isolated, it's systemic. But again, this isn't an iron rule. Take 2019, for example. Auto delinquencies were climbing fast, especially among younger borrowers, but mortgage defaults stayed low. Why? Because people had equity, stable jobs, and the ability to refinance. Stronger buffers protected them. Now those buffers exist today, but they're being tested. Savings have fallen, credit card balances are at an all-time high, and incomes aren't keeping up with the expenses. So the indicator might not be flashing red yet, but it's definitely orange. Next, the structural differences. This is not 2008. Let's get that clear. Back then, the system was built on bad loans, stated income, teaser rates, no documentation, and no accountability. People were literally qualifying for mortgages that assumed home prices would rise forever. Today, lending is dramatically stricter. Borrowers are stress tested for higher rates. Lenders verify income, assets, employment, and everything. In 2008, millions were underwater, or owing more than their homes were worth. Today, the average homeowner has over $200,000 of equity in their home. That's a huge safety net. And this time, large institutional investors, hedge funds, and real estate trusts are sitting on billions of dollars in dry powder to buy if the market dips. So if there's a wave of foreclosures, these buyers could step in quickly and stop prices from collapsing. But, and this is a big but, our weakness today looks different. Instead of bad loans, we have a fragile households. People stretched thin by inflation, borrowers facing renewals at double their old payments, renters locked out of home ownership. If unemployment rises even slightly, those weak points could snap fast. The MPC article calls these accelerants: a stock market correction, rising job losses, or a shift back to expensive urban markets. Any of those could turn a slow burn into a flash fire. So what happens if the fire starts? Let's walk through it. Auto delinquencies keep rising, credit defaults follow, mortgage payments start to slip, foreclosures tick higher, inventory builds, and prices drop. That cycle feeds on itself. Lower prices means less equity means more defaults, and the loop continues. That's how small credit problems become a housing problem, and then an economic one. Now, there's one wild card: institutional buyers. They might cushion the fall, but they might also make home ownership harder by snapping up foreclosures first. So even if we avoid a full-blown financial collapse, we could end up with a different kind of crisis, a housing inequality crisis, where fewer people own homes and more are forced to rent from big corporations. Now, not everyone agrees though. Many economists say the fundamentals are strong, that supply is too tight, demand is resilient, and equity is too deep for a crash. Now, they could be right. Delinquencies are still low, foreclosures are below pre-COVID levels, and most households are still managing. But markets don't just move on fundamentals, they move on fear. If buyers lose confidence, if headlines turn negative, if people start pulling back, that alone can trigger a self-fulfilling downturn. So maybe it's not a mortgage crash we should be worried about. Maybe it's a confidence crash. Here's what to watch for in the months ahead: auto delinquencies, credit card defaults, unemployment numbers, housing inventory, and institutional buying activities. That's your dashboard, your early warning system. Right now, the data is mixed. The buffers are strong but weakening. We're not in a free fall, but we're on thin ice. A mortgage crisis isn't guaranteed, but neither is stability. This isn't 2008 all over again. It's a slow motion stress test for every homeowner in the country. The real question isn't whether the crack exists. It's whether we're ready when they spread. So where does this leave us? We've seen the warnings, we've seen the buffers. The truth is, we're months away from finding out how resilient we really are. Now let's look at three possible futures. Scenario 1, the soft landing. Rates stabilize, inflation cools, and most homeowners hold on. Delinquencies rise slightly, but prices stay firm. Scenario 2, the slow squeeze. Rates stay higher for longer, budgets tighten, some homeowners fall behind, and we see a patchwork market. Strong in some places, shaky in others. And scenario 3, a credit spiral. Defaults spread, prices fall, confidence breaks. That's the true mortgage crisis. But again, it's not inevitable. We can still act. So what are the action steps for homeowners? If you own a home, here's what you can do right now. Number 1, stress test your budget. Add 10 to 15% of your monthly expenses. Could you still manage if rates rise and incomes fall? If not, adjust now before it becomes urgent. Number 2, protect your rate. If you're in a variable rate mortgage, talk to a mortgage broker about locking into a fixed or a hybrid rate. A little predictability goes a long way. Number 3, build a cash reserve. 3 to 6 months of living expenses in an emergency fund. Think of it as an anti-foreclosure insurance. Number 4, pay down high interest debt. Credit cards, personal loans compound fast, and in any downturn, those debts break people first. Number 5, track your home equity. If value starts slipping, talk to a professional early. Refinance or restructure before you're behind. There's a link in the description where you can get your free home evaluation report that can help you track the equity and how your house is performing in today's market. And for first-time home buyers, don't stress, just get in. Buy for sustainability, not status. It's not about timing the market, it's about time in the market. Now let's talk about action steps for investors and realtors. If you're an investor or agent, your move is to go on defense. Diversify. Don't bet on one region or product type. Watch local data. Inventory spikes, price cuts, and longer days on market are your early clues. And keep liquidity ready. If opportunity appears, you need capital fast. For realtors, double down on education. Be the calm voice when clients panic. Explain renewals, refinances, alternative options clearly. When fear spreads, knowledge is power. A mortgage crisis isn't destiny. It's a product of how we act, lenders, government, and homeowners alike. And unlike 2008, people today are more aware. You're watching this, you're informed, and that means that you're ready ahead of the curve. Because crises don't start with panic, they start with complacency. If you're paying attention, you're already doing more than most. So are we months away from a mortgage crisis? Maybe. But the better question is, what are you doing in the months before it happens? Review your mortgage, reduce your risk, build your buffer. And if you're unsure where to start, talk to a mortgage professional you trust. Even if we can't control the market, we can control our readiness. This isn't about fear, it's about foresight. Stay informed, stay proactive, and stay calm. If you found this helpful, hit like, subscribe, and tell me in the comments what steps you are taking to protect yourself from rising rates or a possible downturn. Because the best time to prepare for a crisis is before it happens. I'm Justin Chausse. Thanks for watching, and I'll see you in the next video.